Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Vicor Corporation Annual Report. Vicor Corporation offers a wide range of businesses and services that cater to various industries. The company designs, develops, manufactures, and markets modular power components and power systems for converting electrical power. Their product offerings include brick-format DC-DC converters, complementary components such as AC line rectification, input filtering, power factor correction, and transient protection. In addition to these products, Vicor Corporation also provides custom power system solutions that are designed, sold, and serviced by the company. They offer a range of electrical and mechanical accessories, including input and output voltage and output power products. The company's services cater to various markets, including aerospace and aviation, defense electronics, satellites, factory automation, instrumentation, test equipment, transportation, telecommunications and networking infrastructure, and vehicle markets. Vicor Corporation serves independent manufacturers of electronic devices, original equipment manufacturers, original design manufacturers, and their contract manufacturers. Their products are used in the United States, Europe, the Asia-Pacific, and internationally. With over 40 years of experience, Vicor Corporation has established itself as a leading provider of power conversion solutions for various industries. Unfortunately, I don't have access to the text you provided. However, I can still generate a generic essay on what might cause a stock price to skyrocket. The Vicor Corp stock price has seen a significant surge over the past year, leaving investors and analysts eager to understand the underlying factors driving this trend. Several key events and developments may be contributing to this upward momentum. One possible reason for the increase in Vicor Corp's stock price is the company's strong financial performance. A consistent history of revenue growth, expanding profit margins, and a solid balance sheet can all contribute to investor confidence and drive up share prices. Another factor that could be influencing the stock price is the growing demand for Vicor Corp's products. As technology continues to advance in industries such as renewable energy and electric vehicles gain traction, companies like Vicor Corp are well positioned to benefit from this trend. Additionally, strategic partnerships or acquisitions can also have a significant impact on a company's stock price. If Vicor Corp has formed alliances with major players in its industry or acquired complementary businesses, it could be driving up investor enthusiasm and pushing the stock price higher. Lastly, changes in market sentiment or broader economic conditions can also influence stock prices. A shift towards growth-oriented investing, increased interest in sustainable technologies, or a general improvement in market sentiment could all contribute to Vicor Corp's rising stock price. While these factors may be contributing to the surge in Vicor Corp's stock price, it is essential for investors to conduct their own research and analysis before making any investment decisions. Vicor Corporation maintains a market capitalization of $8 billion, broadly in line with the industry peer group. Vicor Corporation trades at a higher price-to-earnings ratio of 69 times and a higher price-to-book ratio of 11.57 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 11% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Interest expenses are consuming a significant portion of operating income, indicating some financial strain. However, special charges appear non-recurring, suggesting that earnings pressure may be temporary rather than structural. The primary drivers of revenue growth or decline are multifaceted and influenced by various market and operational factors. On the growth side, advanced products have been a significant contributor, driven by improved market demand and higher royalty revenue. International sales, particularly in Asia, have also played a crucial role, with notable increases in exports to China and Hong Kong. The adoption of advanced products by a diversified customer base across various market segments has further fueled growth. Additionally, the transition to larger OEM customers with large volumes scheduled over multiple quarters has contributed to increased revenue. Other factors, such as reduced quoted lead times for semiconductor industry and improved average quarterly turns volume, have also positively impacted revenue. On the decline side, reduced market demand for brick products has been a significant driver of revenue decline. Tariffs and trade disputes between the U.S. and China have had a material impact on profitability, leading to decreased revenue. Supply chain disruptions, inventory risks, and dependence on third-party vendors and subcontractors have also contributed to revenue decline. It is worth noting that patent litigation settlement payments and licensing arrangements with customers have provided one-time boosts to revenue. However, these factors are not sustainable long-term drivers of growth. Ultimately, the success of a company's revenue growth strategy depends on its ability to adapt to changing market conditions and operationalize its products and services effectively. Net income and profit margins underwent significant changes between 2024 and 2025. Initially, net income decreased due to lower revenue from large customers, Section 301 tariffs, and supply disruptions. However, the introduction of a patent litigation settlement payment in 2025 led to an increase in net income by $45 million. The overall net income increased from $6.1 million in 2024 to $118.6 million in 2025. Net income margin also saw a significant rise during this period. The effective tax rate decreased from 41.5% in 2024 to 25.4% in 2025, contributing to the increase in net income. Profit margins also experienced changes, with gross margin percentage increasing from 51.2% in 2024 to 57.3% in 2025. Operating profit margins may vary depending on revenue and product-level profitability. The operating cash flow provided more cash in 2025 compared to 2024, indicating a positive trend. The uncertainty surrounding macroeconomic conditions, trade disputes, and evolving tariff environments may continue to impact net income and profit margins in the future. However, the significant increase in net income and profit margins in 2025 suggests that the company has made progress in addressing its challenges. The company's financial performance has shown a significant improvement in its ability to generate cash. According to the latest figures, the company has successfully produced a substantial amount of positive operating cash flow. This is evident from the staggering figure of $139,548 million reported on page 28. This achievement is a testament to the company's effective management and operational efficiency. The generation of such a large amount of positive operating cash flow indicates that the company is able to cover its expenses and generate excess funds, which can be used for various purposes such as investing in new projects or paying off debts. Overall, this development suggests that the company is on a solid financial footing and has a strong foundation for future growth. The company's debt level has experienced a significant increase over the past year. According to the financial reports, total debt rose from $70,827,000 to $74,015,000 and also increased from $411.59 million to $417.63 million. This indicates that the company has taken on more debt in recent times. In addition to the rise in debt levels, interest expenses have also seen a notable increase. Specifically, interest expense related to unrecognized tax benefits jumped from $36,000 in 2024 to $75,000 in 2025. Furthermore, accrued interest for potential payment of interest increased from $52,000 in 2024 to $125,000 in 2025. These changes suggest that the company is paying more in interest expenses due to its growing debt burden. Management's outlook on the company's strategy is centered around product differentiation and innovation. They emphasize the importance of developing superior solution performance through research and development, continuous innovations, and proprietary semiconductor circuitry. This focus on advanced products is driven by high-growth market segments, with a goal to transition from a high-mix, low-volume operational model to a low-mix, high-volume model. The company aims to maintain its competitive position through differentiated technology and engage in high-level customer support. Success depends on developing and marketing differentiated products for larger customers, particularly in the automotive market, where they plan to penetrate with their advanced products line. Management is confident that cash generated from operations will be sufficient to fund planned operational needs and capital equipment purchases both short-term and long-term. The company's strategy also involves targeting a broad customer base, while acknowledging that a significant portion of revenue comes from a limited number of customers, which is expected due to the early stage of adoption of these technologies. The company has a history of paying dividends to its shareholders. This is evident from the statement on page 17 that confirms the payment of cash dividends on common stock in the past. Regarding share buybacks, the company has authorized several plans to repurchase its own shares. In November 2000, it approved a plan to buy back up to $30 million worth of common stock. This authorization was later increased to $100 million in July 2024. The company has made significant purchases under these authorizations, with a total of 42,800 shares bought back in Q4 2025 and approximately $64 million remaining available for repurchases as of December 31, 2025. The company's share buyback activities have been consistent over the years, with notable purchases including $35.2 million worth of common stock in 2025 and $497,000 in 2024. These actions demonstrate a commitment to returning value to shareholders through both dividend payments and share repurchases. Concerns about inventory buildup and supply chain disruption. The extracted summaries reveal a pattern of concerns regarding inventory buildup and supply chain disruption. On page 6, an order backlog increased by $21,433,000, indicating a potential for future production challenges. The quoted lead time was reduced to 22-28 weeks, further exacerbating the issue. Supply chain disruptions are also a concern, particularly due to tariffs on Chinese goods, page 8. The limited number of wafer foundries and packaging/test providers adds to the uncertainty in procuring key components or raw materials. This is reflected in page 11, where there is an increased risk of excess and obsolete inventories. Inventory buildup is evident throughout the report, with inventory on hand exceeding forecasted usage, page 24. Additional inventory reserves may need to be recorded in future periods. The long lead times to acquire raw materials within the global electronics supply chain, page 33, further highlights the potential for supply chain disruption. Overall, these concerns scattered throughout the report indicate a high risk of inventory buildup and supply chain disruption. That concludes the financial summary for Vicor Corporation. Feel free to comment below, and I will be happy to answer them when possible.